Hey, what's up, everybody? It's Friday. Yeah, Friday, July 8th. Not much happening today. Basically flat. Did you check out the euro, man? Early this morning I saw it got down. The lowest I saw was 100 or 1.008. So we're getting pretty close to parity on the dollar. That's I just quoted euro dollar. And I think we're going to see parity and we're going to see below. But we popped up a little bit after getting down to that level. But I mean, if you think about it, these policies that Europe has embraced, you know, going along with the Russia sanctions, the ban on Russian oil and gas, I mean, that is just really hitting the euro area economy extremely hard. Germany showing a current account deficit for the first time since 1991. Germany is really like, that's the economic engine of Europe. So, I mean, you go along with Washington's neocons, and this is what happens. I'm just curious to see what is going to happen as the euro continues to fall, if that is going to undercut some of the alliance with Washington and the United States policy towards Russia and the sanctions and everything else. I mean, that could be a deal breaker, but you know, we still could fall quite a bit on the euro. I went back and I checked in 2000, which is when the euro started to trade electronically. Maybe it was a little bit before that, but it did hit the equivalent of 80 US cents, so 0.8. And I think we could definitely go down there and see that again. I mean, if the euro area, if the Eurozone policies remain aligned with what Washington dictates, then I think we're just going to continue to see a decline in the euro. It's going to reach some equilibrium level at a much lower exchange rate, and then it'll probably stabilize there. But I think we're in the stage where it is still trying to determine that equilibrium level, so it's going down. All right, let's talk about stocks. Let's talk about the job report today, 372,000. That was a good, strong number. And yesterday I said to you guys that I don't see anything in the daily unemployment benefit flows that is indicative of a softening in the labor market. I mean, daily unemployment benefit flows are 82 million. That's like nothing. I mean, if you go back last year, those flows were averaging like 2 billion a day. And now we're down to 82 million. And it looked like about 2 weeks ago, it looked like those flows were starting to pick up. I think I even mentioned that in a video. And I said, well, we got to keep an eye on that, because if it starts to trend higher, that would be an indication that the labor market was softening up, but turned right back down around again. So, you know, that's just saying that we're not seeing any elevated number or rising number of layoffs. So that's good. The flows in yesterday's daily treasury statement was marginally positive. We had an 880 million positive flow day, which again, when you talk about, you know, the size of government spending, an 880, that's basically unchanged. It's basically a flat spending day, but at least it wasn't a drain. Okay, that's the thing that is important. So we had a couple of days in a row now where I had been expecting to see a fiscal drain. That hasn't happened. So it's basically been flat to slightly positive, and that's a good sign. I would not be surprised when we see the data on Monday for today that we saw a slight drain given the way the market behaved. But as I've been telling you guys, you know, it's leaning positive for July and August August, very positive, okay? Because August, we're going to have a quarterly interest payment that's going to be like 44 billion. So for July, August, and up until September 15th, the fiscal picture is leaning positive. So we should see a slowly rising stock market, and you can buy the dips. I've been saying that every day. I like bank stocks a lot. We bought back into the energy a couple of days ago when it was down hard. Oil crude was up today. All right. I'll mention, I checked out the CFTC's latest commitment of traders release, and oil producers, again, they were net buyers. They were net buyers in the week ending just this past Tuesday. So what was that? That was the 5th. So oil producers, again, net buyers, and that has not changed. I mean, they've been net long WTI futures since last August, okay? And they have not come anywhere near reversing that position. What they've been doing is they trim it down a little bit every time we get a rally up towards $120. But then when we come down towards $100, they're back in there either covering short positions or just outright adding long positions. So they're still bullish on the market. Gold and silver, again, in the decline that we saw in the latest week, they were big buyers. And it wasn't just that they were short covering and adding to new long futures positions. So they keep buying the dip, and the price decline, I mean, that's all speculative liquidation. I didn't check out the spec position, but you know, I put that in my report every week anyway. My subscribers will get that. What else is going on? Oh, loans. So checked out the banking data. That was what, for the week ending June 29th, I believe. Another increase in loans pretty much across the board. We saw an increase in commercial and industrial loans. There was an increase in real estate loans. There was an increase in consumer loans, which included credit card and automobile loans. Not to mention the fact that bank assets were up, and bank residual, which is basically capital, that's bank assets minus liabilities, that was up sharply. So the bank sector, I mean, it's looking really healthy. And as I've been saying, you know, once the Fed really gets rolling on QT, and I did a video on this yesterday, you know, I can't wait, because, you know, this whole narrative about QT that we've been hearing now for almost a year about how, you know, there's going to be this massive liquidity contraction, and it's going to, you know, that's going to be the next leg down, and you know, the next shoe to drop, and doomsday, and this and that. And I've been telling you guys, you know, these people who are predicting that, I think they're going to be very, very surprised. The reason being that the Fed needs to drain reserves from the system. Once again, I mean, it had to create a special vehicle, that reverse repo facility, just so the banks and money market funds were able to shunt off those excess reserves into that facility. Otherwise, they would be in violation of the Fed's own regulations. It's a cockamamie setup. You know, the easiest thing they could have done was to extend the extension on, remember during the pandemic when they took reserve balances out of the calculation of, they suspended reserve balances from the calculation of the leverage ratio, but then that came back into being last March. I should say that was in March 2021. And because of pressure from Congress, actually it was pressure from Elizabeth Warren, the Fed reinstated you know, the calculation of reserves into the leverage ratio, But I mean, that's all. I mean, it's just like a regulatory construct that, the Fed really has control over that, not Congress. I mean, Powell just buckled to pressure from Warren. But anyway, what I'm saying is that the very fact that the Fed had to create a special vehicle so that the banks were able to, push those reserves off their books into that vehicle is evidence that they want reserve balances to come down. So the Fed has to, once it really gets going with this QT, it's going to be bullish. I mean, it's going to alleviate that pressure on the banks. They will be able to add other assets, namely loans, and I think we will see an acceleration in the growth in bank credit. And that's good because, like I said, I've been saying actually that the slowdown in fiscal is going to require, some other offset. And if banks can provide credit, that will be the offset, at least for a period of time. And I know everybody's saying, well, that's debt and they're piling on debt. Yes, I understand that. And at some level, that debt can become a problem. But right now, again, I'll repeat the fact that, at least from a historical perspective, debt service burdens, in other words, how difficult is it to service that debt every month? And I'm talking about in the aggregate, in the big picture, not like individually. I mean, a person might have difficulty right now. I understand that. But overall, debt service burdens are very low. They are nowhere near what we saw in 2007 when debt service burdens then as a percentage of disposable income was like around 14%. Now it's about 9 point something percent. So that's still significantly down. And that 13.6% in 2007, that was a record amount of debt burden, like the difficulty of servicing that debt. So even now with the rate hikes, it has not even come close to that level. So what does it mean? It means, again, this idea of credit worthiness, still very good. So, you get some relief from QT, banks increase credit creation, it offsets what's going on with the slowdown in the fiscal. And that's positive for the economy, and it could run on that for at least a period of time. We've got to monitor those debt burdens levels and see, when they start to get up to that level that we saw in 2007. But right now, I don't see that as any problem. So yeah, I mean, this is, like I've been saying, this is just going to be a slow grind. We got used to the last 2 years with these massive pandemic-related stimulus packages that we had. So, I mean, the market was straight up. We were getting, huge amounts of fiscal flow every month. We didn't have, at least initially, there wasn't the supply chain issues and everything. And I think it's really more than the supply chain issues. It's the sanctions. It is the embargo on oil and energy and this stuff, because really, if you look at where most inflation is coming from, it's coming from the energy sector, and that it has everything to do with what's going on with Russia, Ukraine, and the sanctions that the West has imposed. I mean, that's all self-imposed. So, and that's a negative. I mean, I admit that. That is a negative. Inflation is a negative. That is a flow to the foreign sector. That's income that's siphoned off. It doesn't stay in the domestic economy. It's a subtraction of GDP, and it's better if we didn't have that. But, that's the policy that is in effect. And I don't see any relief coming to that policy. I mean, Biden was supposed to suspend or end some of these China tariffs this week. That was the talk, but I don't think he did anything on that. I mean, that would have been helpful, at least to a certain extent. But I didn't see anything done on that. I mean, it was talked about that he was going to do that, but nothing. I don't know. And the other thing that I keep saying is like a ban on petroleum exports. That's another thing that he can do, but he doesn't seem to want to do that either. And the irony is that the big drawdown that we've seen in the SPR, Strategic Petroleum Reserve, which is down 120 million barrels from last August. I mean, a lot of that's being exported. That's our strategic reserve of petroleum that's being sent to China. I mean, we're not benefiting from that really. Maybe it's helped a little bit to boost domestic inventories, but that's going to end in September. That drawdown in the SPR is going to end in September, and then you're going to see, I think you're going to see again a renewed drawdown in domestic inventories of crude because we just keep exporting the stuff. So I think the oil outlook looks bullish. And every time it gets down here, I said this the other day, every time it gets down here around 100, you got aggressive buying by producers. And not only that, this SPR drawdown, part of the what was decided in that was that the government would also buy back under $100 a barrel. So every time it gets down, every time the price of crude gets down under 100, they're buying back for the SPR. Eventually the SPR is going to be refilled anyway, but they're doing that when price gets down below $100. So, I mean, that's kind of like a floor. You can trade that. Every time it gets down below 100, you go long because they're buying it back. They told us that. Anyway, that's it for today, folks. Remember, if you want to get check out my MMT Trader, go to pitbulleconomics.com, sign up for a 30-day free trial. The link is in the description below. Take it easy. Bye.